amid growing concerns about economic growth.
Consumer spending was
As
soft.
expected, cut interest rates another quarter point.
We are following breaking news. All three major American stock markets have closed down.
Bitcoin rose 10%.
Even gave the stock market a temporary second wind.
The market reaction, it was kind of nonplussed.
Tariffs going into effect tomorrow.
But the NASDAQ was also.
Investors will be watching closely for more clues about the direction.
It's time to tune out the noise and tune in to great information with a steward's view. Expect valuable economic updates, investing techniques, and planning concepts that move you to be wise and decide well. With your host, Aaron Kolkman, president of Fidere Advisors in Minneapolis. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time with a steward's view. A Steward's View is brought to you by Fidere Advisors, a registered investment advisor. You can listen to this podcast and previous episodes at fidereadvice.com. That's FIDERE advice.com. Now here's your host, the president of Fidere Advisors, Aaron Kolkman.
Welcome back to A Steward's View. Like, listen, and share. You can find us on Apple Podcasts. You can find us on Spotify and on SoundCloud, even YouTube. So please do find us, like, listen, and share with friends, family, others you think might have an interest. We're just getting moving. It's been a big week, and another one is ahead. The S&P 500 dropped last week to 5580, down 1.5%, and I'm rounding. The NASDAQ 100 was also negative, down 2.39%, while small caps fell 1.64%. Internationally, developed market stocks on the MSCI EAFE dropped 1.35%, while emerging markets fell 0.94%. In fixed income, yields on treasuries were flat roughly, with the 10-year unchanged at 4.25, and the 2-year fell 4 basis points to 3.91. Wednesday is Liberation Day, as President Trump likes to call it. The day will feature the announcement of reciprocal tariffs that have been floated for the past 2 months. Over the weekend, President Trump stated that he wanted the Treasury Department to go bold with the tariffs, and that his concern was that they might not be large enough. These comments sparked panic in the market and led to a sell-off in equity futures and early morning trading on Monday. While it's generally expected that reciprocal tariffs will be a mirror of what other countries are placing on the United States, the exact amounts are unclear, with many speculating that the average tariff will increase by 10 to 20%. For the consumer, these tariffs could put divergence between soft and hard data further. The sentiment reading last week fell from 57.9 to 57, its lowest since November of 2022, and down from a reading of 74 in December. Furthermore, the one-year forward inflation expectation jumped to 5% versus current core PCE inflation of 2.8. We'll get more hard data this week when the non-farm payrolls report is reported on Friday. Expectations are for a net add of 135,000 jobs, following last month's slightly weak 151,000. For right now, I'd like to go into a little segment about what's coming in the weeks and months ahead. When we go out to equip you, the listener, to be wise and decide, well, what is it we're equipping you to do? Well, we hope that in the end, your plans function better, right? That would be the end game. Before that, we need to give you some context. That's the economics of what's going on. And in the middle of that, we need to spend some time around this big umbrella called investing. And I'll set aside trading to be clear. I think we've gone there enough in past programs to say it's clear that we're not talking about day trading or short-term trading or looking at the market in just technical, tactical terms so we can make a quick buck. Okay, we're talking about allocating money in a long-term fashion in vehicles that are efficient, that are productive, that are going to give us, get us closer to our goals, right? Whatever those are. So that's what we're talking about when we say the word investing. So with that, the months of April and May, I'd like to specifically focus on investing. In June, we'll get more into planning, specifically connecting life and financial planning, and what I see as 4 phases of our lives that we can plan with or plan from. And we'll also talk about the Life Cycle of Wealth book that is, yes, Chaz, still available online. I would encourage our listeners to get the free copy, which is available at fidearadvice.com/Kolkman. Okay, so there's the plug that I haven't made, right? If you want to add applause, you can. But here it comes. Thank you. Oh, wow, that's just too much. So if we'll get into the Life Cycle book and some of that content in the month of June. Before we get there, there's a lot more than 2 months of content that we could go to just on the topic of investing. I mean, we could be here for years. But in April and May specifically, I want to spend April looking at active and passive investing and the differences and really what it means to be efficient in our portfolios, okay? And how we build portfolios, how we measure portfolios, those two things. And then in May, I'd like to spend time talking about income investing, okay? Because so much of what happens with investing is, if we're funding goals with it, we're going to end up needing some income from it, okay? And how do we take income from portfolios, okay? There are programs just dedicated to that, okay? So let's spend the next couple of months in those areas and then get into planning, because I think when we do that, we'll be better able to see the effects of these investment techniques, I'll call them, on the plan and the goals that are being funded.
So real quick review. April is active and passive investing, really portfolio construction and the efficient way of going about it and measuring it. So construction and measurement of portfolios. How about that? May is income investing, and June is planning, life and financial both. Okay. Fair enough. Thank you, Chaz. So Chaz is the proxy for all of you in the audience that are wondering, like, what is he really saying? Okay. So let's go to what's coming, what's right around the corner. We have this month of April coming up. We're going to spend time talking in more detail about active investing, passive investing, and what I'd like to just call efficiency investing. Okay, because as you'll hear me talk with Brian Mumbert from the Timothy Plan, and you'll hear from him in the second half, but we talked about this either or, and I referenced active and passive investing. Okay, so in my mind, and this is going to be, people are either going to dismiss this because that's the training that they've had, or not. I hope they don't, but I would argue that it's not an either or. Active and passive investing is actually both are good, is what I want to say. Okay. So what usually happens is, the Vanguards of the world, and I want to pick on Vanguard, but indexed investing companies, those that employ computers more than people, that charge very little to have your assets set up in a pie chart and match up with whatever the market's doing. Okay. That's passive or index investing. Okay. It could be one index, could be 15 like we use, and I'm rounding, versus active investing, which is where you have more people than you do computers, at least in terms of brain power. Please set AI aside. Okay. And then you have decision making going on from the human side, right? And yes, they have computers, but the idea is that they can make decisions to benefit investors beyond what the index is doing, their relevant area. Okay. And that either risk or return or both, right? That is active. Okay. And it has a cost, doesn't it? It's higher cost to do that as an investor or to employ that approach. So isn't it true then that higher cost can get a bad rap? Yep. So the either or, I want to call it a both and, right? And there are many reasons for that, but let's just say this: whether I pay 0.25% or I pay 1% or 0.1% or 2%, whatever I paid to have the strategy or the area of the market that I'm invested in work for me, as long as I calculate after that fee what I kept, what the risk was after the fee, what the return was after the fee, that is what I really need to focus on, yes?
Okay. So if we can agree on that net is really the point, I hear some planners say, well, you pay for what you get. Well, not always. It's really a matter of, did you get something that you expected after the fee, whatever it was, right? So let's not get hung up on fees is what I'm saying, but let's also recognize that index investing, here's why I'm pro index investing. So I'm an active investor that likes index investing. That's like a two-headed monster there, the way it sounds. But I like index investing because it's efficient. We get the risk of the market, we get the return of the market, nothing more, nothing less. Okay, so if that's your goal, and you're choosing, frankly, to focus on fees, then that's exactly what you should do, right? With or without an advisor, with or without somebody like me. However, if you could do better on risk or return or both by being an active investor, then I would argue that you should do that. Sure, the fee should be reasonable. Is it going to be higher? Yep, we already said that. But my concern isn't really what the fee is in either case. It's that I got something that was efficient. Okay, so what? Well, the so what is what we're going to unpack over the month of April. And it just to kind of tease it out a little bit, there are areas of the market that are great to index in, like the S&P 500 that we talk about a lot. There are areas of the market that are not so great to index in, like less efficient areas, emerging markets, let's say, right? Undeveloped markets in the world. And I'm specifically talking about stock markets. Okay. There are strategies for reducing risk that we'll hopefully have a chance to talk about in April that would be superior in active investing that aren't available in index investing because there's just a computer tracking the market, right? Could you enhance that? Sure. But the idea is if I can come up with something after fees in a combined overall portfolio that's global, I might have some of both, but it depends on how I'm measuring what I'm doing. But we'll start with this. The after fee number, risk and return, and I use Sharpe ratios for our clientele. They know I'm very focused on what's the 5-year Sharpe ratio of your overall portfolio, the whole thing. If you know how you're measuring, then you can build something that is going to be efficient to that end, right? Okay. Now, we'll come back to measurement in the month of April, but I wanted to unpack a little bit about this index and active investing conversation instead of an either or. So I'll leave it there, but in the month of April, let's get further into those topics.
More of A Steward's View in just a moment. Investors have stocks, bonds, mutual funds, ETFs, options, futures, real estate, and more. There's one place to look at all of your portfolio. It's called Fusion. Portfolio aggregation. No contract, no hassles. Fidere's portfolio technology gives its users a chance to see all of their assets all the time, wherever they are. The Fusion platform is open for use without a contract and without a hitch. It's based on mean variance optimization and analysis research by Aaron Kolkman. Fidere uses the Fusion platform to optimize assets for its clients. For more information, visit fidereadvice.com and click on Fusion at the top of the page. That's Fidere Advice, Fidere advice.com. Now back to A Steward's View with your host, Aaron Kolkman.
Welcome back. We're talking with Brian Mumbert at Timothy Plan. He's the Vice President of Advisor Relations. And Brian, welcome.
Thank you. Happy to be here.
Good. So Brian, Timothy Plan is known for biblically responsible investing. And tell us a little bit about that.
Yes, Timothy Plan was originally founded to be a retirement plan for non-denominational pastors. And when we started this 31 years ago, there was no one really doing what we set out to do, which was really to help align Christians with an investment product that matched their values. Up until this point, there had really only been social investing products out there, screening some things for alcohol and tobacco, but nothing that dealt with big moral issues like abortion and pornography, which is really the crux of what Timothy Plan wanted to be, founded on biblical principles.
Excellent. And how long ago was that?
The Timothy Plan started as a concept in 1992 and then as a mutual fund in 1994. So we're 31 years old.
Okay. And in the number of funds now that Timothy Plan is sponsoring or running?
Yes, Timothy Plan now runs 12 mutual funds and 7 ETFs, all screened on the same principle that we built to be a pro-life, pro-family investment company.
Interesting. And so tell us a little bit more about how Biblically Responsible Investing is working now at Timothy Plan, specifically maybe some of the process or the advisor or sub-advisor relationships that are going on. We have a unique opportunity to talk with a couple of professionals from Chartwell Investments that are coming on, and they'll be here soon to join this program. But my context question for you is, what about that process? How's it going? How's it working? Maybe something about how unique it is in terms of those sub-advisor relationships or even the filters themselves.
So Timothy Plan starts with the filters themselves. And if you were to boil down everything that we do, it would be to protect the most vulnerable in society. And that most vulnerable would be either the unborn in the case of abortion, or in the most vulnerable that have addiction in society, whether it's like addictions to pornography, addictions to alcohol, tobacco, to gambling. Companies that make products that prey on these addictions that ultimately we have decided to, as a biblically responsible fund, not to profit from that. And so from those parameters, you can build out everything that we do. And then what we do is we work with sub-advisors like Chartwell, who has been a great partnership for us since 2008 on our small mid growth fund and our large mid growth fund. And they take the screening that we do and then apply their process, which you're going to hear about later, that talks about how they manage the fund. And it all works in tandem to create a very competitive product while allowing Christian investors to invest with their values.
Excellent. And that is so refreshing for my brain to hear in 25 years of time, and I'll say 20 specifically, with the 5 models, the same 5 models that I've run during that 2 decades. I have yet, I'll say through December of 2024, there were no BRI firms that made it through the screens that I run. Okay. That's not to say that there are BRI firms doing a poor job. It's just to say that in terms of getting to the best of the best risk-adjusted returns, which is what I'm looking for, I wasn't finding any, right? I was finding, non-BRI firms, which is the majority of the investment marketplace. Yes. So what an accomplishment in my brain to hear the process you just described and to have already been back in January, looking at TAAGX, that's Tom, Apple, George, X-Ray, the small mid-cap growth strategy from Timothy Plan, run by Chartwell, and say, oh, this is an opportunity for Fideer, my firm, to engage with BRI. And so finally, in 20 years, I get to have this conversation with you, right? And so thank you. What is in the sauce, if I can ask?
In the sauce.
Yeah, I'll ask that on, when we have, it's specifically Tim Riddle and Teresa Tran from Chartwell joining us. But how did you show up on my radar all of a sudden? That's what I want to ask.
Chartwell has some stellar record in especially the small and mid growth space. And I believe we can look back about 5 years ago, and they'll tell you more about this, but really getting Frank Sesarcik on the portfolio. He's done a phenomenal job with him and his team in the process. It is something that just gels very well with what Timothy Plan does in the screening that we do. And they have worked their way into constructing a portfolio, as you'll hear later, that really drives a competitive return and does so with such a like-mindedness for the screening that we do, too. I mean, several people that work at Chartwell are very much of our same faith and really appreciate what we do. And so it's just a great partnership that we very much value.
Excellent. And I meant all of that question in context as a compliment, by the way. So kudos. I'm really, really excited that we can include a BRI firm. I end up in my office, just so you know, Brian, I end up having this either or conversation. right? Much like we're about to have in this program in regard to active or passive investing. Okay. And I don't want it to be an either or, right? I want it to be a both and, because, to say, well, there are a number of believing families, Christian families that are being served. And, for me to say, well, we can help you filter these things out, but then you're going to have to give up some return or take some extra risk or both. That's not very palatable, right? People don't go, oh, sure. Yeah. I'll, take my million, our minimum account size is $1 million. I'll take my $1 million and I'll just give up, 1 or 2% a year, or I'll take extra risk to get the same return or whatever, just so I can have BRI filters, applied to what I'm doing. Do you see what I mean? So that either or was so difficult for me, especially when I'm talking with faithful providers like you, that now I get to go, oh, I don't have to have that conversation anymore.
Absolutely. This has been a struggle for the industry as a whole, and I've been working here for 19 years, and I can tell you, it's come so far. And a lot of it just had to do with, can you prove that the process works? And then can you find like-minded managers like a Chartwell that can take your process and your filtering and screening and still do some of the best work that's out there to get the very competitive return. And so we're very excited that it has come so far over the 31 years in existence, because like you described, early days, it was a challenge. We were asking people to give up something to do this, and there were faithful that did, but it was a hard pill to swallow sometimes.
Brian, thank you again for joining us. Before we sign off, could you tell us a little bit more about where people can go to learn more about Timothy Plan, or what you'd like them to know?
Absolutely. You can find everything you need to know on our website, timothyplan.com. Again, that's timothyplan.com. You can find all of our investment products there, learn more about the sub-advisors and the performance of the funds, as well as all the filters that we do, because we couldn't cover everything here. And you'll walk away hopefully seeing that we are as transparent as we can be, and that we are a Christian company, and one that values upholding your values in investing.
Excellent. And Brian, we so appreciate this. We'll have you on the program perhaps in the future. Really, thank you for your time. We've enjoyed talking with you.
Absolutely. Thank you.
You bet. Looking forward, Wednesday is Liberation Day. That will also feature ADP employment changes, factory orders, durable goods orders, and cap goods orders. Thursday will feature the initial jobless claims report, final March service PMIs and ISM services, and the Challenger job cuts. Finally, Friday will close out the week with non-farm payroll reports, as well as the consumer credit data. So this is a big week ahead, and I just want to encourage everybody to take a breath, tune out the noise, and be wise and decide well.
You've been listening to A Steward's View with your host, Aaron Kolkman, president of Fidere Advisors. To learn more about Fidere Advisors or speak with Aaron, visit fidereadvice.com. That's FIDERE advice.com. While there, you can also enjoy the free Fusion platform for portfolio aggregation. Just click Fusion at the top of the page. To listen to this and other episodes of A Steward's View, visit the website Fidere Advice and click on A Steward's View podcast link at the top of the page. Fidere Advisors is a privately owned full-service life planning firm offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plans for families it serves. Fidere maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions, and is for informational purposes only. Fidere and its representatives do not offer tax or legal advice through Fidere. Please consult the appropriate advisor. Fidere Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidere, please visit fidereadvice.com. That's FIDERE advice.com or call 833-2FIDERE. That's 833-234-3373.